Markets go up, markets correct. But the real question is, will your mutual fund strategy handle both? Multi-cap and flexi-cap funds both invest across large, mid and small caps. But one follows strict allocation rules, while the other gives the fund manager full flexibility. That one structural difference can completely change your risk, volatility and return experience. So which one actually fits your portfolio? Let's break them down clearly. If you have been confused between these two popular mutual fund categories, this video will give you complete clarity. Hi everyone, I am Divya Grover. Today we are breaking down the key differences between multi-cap and flexi-cap funds. By the end of this video, you will clearly understand how they work, how they differ, and which one might be right for you. Let's start with the foundation and understand why market cap allocation matters. Different market cap segments come with different benefits and risk levels. Large cap stocks offer steady growth with lower volatility. Mid cap and small cap stocks have the potential to outpace large caps, but they are highly volatile. When you combine different market caps in your portfolio, you improve long-term wealth creation and minimize overall market risk. That's how you achieve better risk-adjusted returns. This is exactly why categories like multi-cap and flexi-cap funds exist. Both invest across market capitalization to offer diversification. But even though they invest across market caps, they are structured very differently. Let's break them down. What is a multi-cap fund? A multi-cap fund must invest at least 75% of its assets in equity and equity-related instruments at all times. Out of that 75%, at least 25% must go to large-cap stocks, at least 25% to mid-cap stocks, and at least 25% to small-cap stocks. So there is a mandatory allocation structure. The remaining portion can be allocated freely. However, this strict framework limits the fund manager's ability to shift allocations based on changing market conditions or valuations. What does this mean for you? Strong structural diversification, better long-term wealth creation potential, but higher short-term volatility. Since at least 50% of the portfolio is always in mid and small caps, volatility can be significant during market corrections. That is why multi-cap funds are suitable for investors with high risk appetite, a long-term investment horizon, and those comfortable with volatility. But remember, in a strong bull market, this higher exposure can lead to higher returns. Coming to what is a flexi cap fund, flexi cap funds must invest at least 65% in equity and equity-related instruments. But here is the key difference. There are no minimum or maximum limits on large, mid, and small cap allocation. This gives the fund manager complete flexibility to dynamically adjust the portfolio based on market conditions, valuations, and economic trends. In practical terms, most flexi cap funds tend to tilt towards large cap stocks with selective exposure to mid and small caps. This balance helps manage downside risk, participate in growth, and deliver relatively smoother return paths. In terms of risk, flexi cap funds often sit between large cap and mid cap funds in real world portfolios. Now let's talk about the risk. Since at least 50% of multi cap funds is in mid and small caps, if market corrects, the negative impact can be higher. This is because smaller companies are prone to higher volatility, increasing the portfolio risk. In short, the risk is high. But when markets turn bullish, multi-cap funds can offer higher upside potential. On the other hand, because most flexi-cap funds maintain higher exposure to large caps, they generally offer better stability during market corrections compared to multi-cap funds. Additionally, a flexi-cap fund with its dynamic mandate can explore investment opportunities better than a multi-cap fund when conditions allow. So which of the two is better? Both are good options. They simply serve different investors. Multi-cap funds offer broader structural diversification, provide exposure to fast-growing segments, and have higher upside potential. But they come with higher volatility and deeper drawdown risk. Hence, they require patience and ability to handle higher risk. Meanwhile, flexi-cap funds offer relatively stable returns across market phases. They also adapt easily to changing market conditions, and they suit investors with moderate to high risk tolerance. Ultimately, the decision should depend on your risk profile, your financial goals, and your investment horizon, and your confidence in the fund manager. Ideally, you should avoid choosing either category based on short-term performance. Both can even coexist in your portfolio, one providing stability, the other aiming for growth. And remember, fund categories are just frameworks. Wealth creation does not happen by simply choosing the right box. It happens by staying invested through market cycles, especially the ones that test your conviction. Whichever category you choose, evaluate schemes on qualitative and quantitative parameters and prefer SIP mode to manage volatility and benefit from the power of compounding. That's your complete breakdown of multi-cap versus flexi-cap funds. Now you can decide based on clarity, not confusion. For more insights on mutual fund investing, subscribe to the Equitymaster YouTube channel. Happy investing! Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.